As we heard from Neil Kashkari this morning from PIMCO, these are the 5 major risks to corporate profit margins, according to him. He was, as I mentioned, on our program in the last hour. Despite those risks, as you see cost of labor, economic slowdown, dollar strengthening, and so on, Neil believes that margins will still remain high. Our next guest has some specific stocks that he says have significant margin upside. He's Pat Dorsey, the Director of Research at Sanibel Captiva Trust. And of course, Josh Lipton and Dominic here joining in on this conversation. And Pat, as I'd mentioned, Neil outlined some risks to corporate profit margins. What stocks would you be in to hedge again any possibility of margins going down here?
Well, so I think, what you want to look at is companies that are undergoing either secular change or change that's not well priced in by the market. So Express Scripts would be a good example, the big PBM that just finished closing its purchase of Medco. They'll have about a third of the U.S. PBM market, be far bigger than their nearest competitor, Caremark. And I think history shows that operating leverage, margin expansion, tends to get mispriced by the market. Right now, Express Scripts runs about a 5% margin. We think from cost synergies from this massive acquisition, PBMs are a scale business, they should be able to drive margins north of 7%. Now, 5% to 7% doesn't sound like a lot, but on a percentage basis, that's a massive improvement in profitability, and I don't think the street has priced that in yet.
Okay.
Well, I mean, one of the things we talk about, Pat, sometimes is this idea that if you talk about the margin story, do margins correlate to stock price? I mean, we heard from Intel earlier this past week saying that their margins for the second quarter may come in a little bit shy of some analyst estimates here. Does a margin that goes down necessarily translate into a lower stock price? And if that's the case, what exactly should investors be doing about those margins who some appear to be peak, at least for now, Pat?
Now, that's a great question, because certainly if your margins are coming down, but you're driving much, much faster top-line growth, then overall the picture is good. Google would be a great example of this. Their margins in mobile search are materially lower than their margins in their core search business, but mobile search is growing so quickly, and it's so important for them to have a strong position in that market to maintain their competitive advantage, that it makes a lot of sense for them to be getting a lower cost per click, driving lower margins, but still keeping bottom-line growth moving forward. So that's a case where you're seeing some margin pressure, but overall profit growth is still very robust.
Now, talking about profit margins and various companies to be in, I mean, some are also in on dividend plays, right, Pat? And look, we were just talking with a congressman about what could happen with taxes. Is there a temptation to either, to sell off some of your dividend plays in preparation for higher tax rates?
I mean, I think that's the fear for most investors. My question would simply be, what do you plan to do with the money? Because your yields on dividend-paying stocks are generally still better than in most corporate bonds. And of course, corporate bonds, well, that would be great. And if you do that, you'll lose a third of your purchasing power in a decade at 3% inflation. Not my definition of safety, personally. And so I think, what it does is certainly it makes dividends less attractive on an absolute basis, but they're basically going to be taxed at the same rate as ordinary income, your interest income. And right now, with a high-grade corporate bond yielding, in the low 3s, you're getting a lot of dividend-paying stocks yielding 3 and 3.5. And of course, they're growing those dividends at 6 to 7%. But of course, fixed income is, as the name implies, fixed.
Hey, Pat, it's Josh. I know you're finding opportunity not just domestically, but also internationally. You've been buying in Europe. What opportunities in Europe right now specifically are you looking at?
Well, so I think, very big picture in Europe, you want to stay away from the capital markets. I think that the risk of bottom fishing in, say, European banks right now, they're very cheap, but that is not a trade for the faint of heart. I'm sure you can make money there, but it's not a trade without risk. Overall, the Euro Stoxx 600 is trading at about 10.5 times earnings, yielding between 3.5% and 4%, which seems to me to be pricing in a large amount of risk. And I would say, thematically, you want to be looking for strong balance sheets and export companies that are being dragged down because they're domiciled in Europe, but most of their business is not tied to Europe.
Pat, thank you very much. Really appreciate it. Pat Dorsey.